to valuating stocks. We have bond and stocks. All of them, these two are major part of the capital market. Capital market, including bond and stock. Let's make it easier for preferred stock. To remember the characteristics of the preferred stock. So the preferred stock, that means what is a preferred stock? Preferred stock is that dividend is fixed and paid forever. So you can see this is a preferred stock. So this preferred stock that they pay dividend $2.31 end of the first year, in the second year, the third year, until infinite. So that means you will get dividend the same amount forever. Okay, that's a preferred stock. So if that dividend will be paid forever, how are you gonna determine the price of the preferred stock? Okay, so this is how you calculate the value of preferred stock. So you just discount all the future cash flows, okay? Discount all the future cash flows to the present. And you sum them up. That's gonna be the present value. Okay, so we have a very, you can do this way step by step, okay? Calculate required rate of return. This is a KP, that means the required rate of return of preferred stock. And you calculate the price. But there we have a much easier formula, and they give you that same solution, which is the dividend divided by the required rate of return. Okay, the preferred stock, if the required rate of return is 10%, so the price of the preferred stock will be the dividend divided by the required rate of return. Okay, so you can easily to get that is $23.10. Okay, what that means? The meaning is that, you know, preferred stock, you can consider that as a perpetuity. So the perpetuity is, that means you can use the dividend divided by the required rate of return. Okay, next we talk about the valuation individual shares of common stock. Okay, for individual stock, and there is one particular case. Okay, the particular case is the dividend is the same forever. Okay, it's similar to preferred stock. So that is going to be the present value of all expected dividend discounted at the investor's required rate of return. So we call this type of common stock is called zero growth. It is zero growth. The dividend is the same. Okay, dividend is the same forever. Then you can consider this type of common stock, zero growth dividend model, as a perpetuity, and that's similar to preferred stock. Okay, so you can use the same like the dividend divided by the required rate of return to get the price of this common stock. Okay, but most common one is constant growth dividend model. Okay, sometimes they call constant dividend growth model. So whatever. You just assume that dividend will grow at a constant rate. So dividend will grow at a constant rate. For example, the current dividend is D0. Next end of the year, next year, is going to be the D1 equal to the D0 times 1 plus the dividend growth rate. The dividend growth rate is G%. Okay, this G, that means is G%. So you will use the current dividend times 1 plus G%. And the second year, okay, the dividend will be D0 times G% squared. So the 30-year dividend, current dividend, times 1 plus G cubed, and all the way until infinite. So every year the dividend will increase G%. Okay, so if you calculate the price of the common stock, okay, this is gonna be your dividend. Okay, the dividend at current times 1 plus G%. This is D1 actually. Okay, so you can see the D0 times 1 plus G% is D1, and divided by the KS minus G%. The KS is the required rate of return of common stock, and the G is the dividend growth rate. Okay, so we have this is the formula. Okay, this is the formula we can do using as dividend growth model. Okay.
Yes.
Yes, any questions?
Hi, I'm doing well. How are you? Good. Yeah, I am. I'm hanging in there. How about you?
Yeah, you okay? Okay. If you want to talk, you can unmute. So I basically unmute all the students' microphone. Okay. Okay. So we have this dividend growth model. Now we're using this example we have. What is the value of a share of common stock if the most recent paid dividend was $1.14 per share, and the dividend I expect to grow at a rate of 7%? Assume that the required rate of return is 11%. Okay, so what will be the price? Okay, so we have current dividend 1.14. Okay, we have current dividend. Current dividend is D0. The D0 is 1.14. And what else we know? We know that dividend are expected to grow at a rate of 7%. Dividend growth rate. Okay, this is in the formula, this is letter G. Okay, this is letter G. And also we know is the required rate of return. Okay, the required rate of return is 14%, 11%. Okay, 11%. Okay, this is we call the KS. Remember, so we're gonna use this formula, okay? This is the formula for the price of common stock. This is going to be the D1, okay? D1 or D0 times 1 plus G percent divided by the K has minus G percent. Okay, so first we wanted to know the D1, or you can use D0 times 1 plus G percent. Okay, so we have the common stock price. You calculate the stock price, common stock price P0, that is equal to D0. Okay, so you have a D0 times 1 plus G percent. Okay, and then you divide it by KS. Okay, this is the required rate of return minus dividend growth rate. Okay, that's the formula. So you can do is just click on enter. You can click on enter. So the stock price, common stock price is $30.50. Okay, $30.50. So we also can do is using the free cash flow model. So to estimate the free cash flow of the company. And since this chapter 11 is skipped, this is how you calculate free cash flow. So the